In this video, I show you exactly how you can master bull flags and bear flags. This is how a bull flag would look like. And if we break it down, we have an impulsive wave, so we are in a trending environment. And it's really important to understand that a flag pattern is a trend continuation phase. So we are in an uptrending scenario. Then the flag is the corrective wave where the market pulls back against the initial trend direction. And then at some point we have the breakout continuation and the market is going into a new impulsive wave. With the flag, the goal is to trade the continuation. And there are quite a few ways of how we can achieve that. So when we look at a chart, obviously it doesn't look as pretty as when we just draw it out, but you will often find flags. We have the impulsive leg up, so the impulsive bullish phase. Then the market is moving against the trend direction, and it is really important that you stop chasing the price. A lot of traders have problems with chasing the price. When they see the market is going up, they immediately jump on the long trade, and then the inevitable pullback, the inevitable correction is coming, and you're much better off waiting for the correction and trying to master trading the correction. And then at some point, the market is rolling over. Obviously, in not all the cases it is going to happen, but in this video, we're trying to figure out how we can master those transitions where the market is going from corrective back into impulsive. And this is the rhythm that you will often see on your charts. Impulsive, corrective wave with the flag, impulsive, corrective wave with the flag, and so on with the impulsive. So now let's try to understand how we can trade flags and how we can identify them and also identify the transitions. So in this example, I have added a moving average. This is the 50 SMA. You can also use a 50 EMA. And what you will often see is that the pullbacks, the flags, but many other pullback patterns will often reach the moving average. And this is a great way of distinguishing between an impulsive phase and a corrective wave. When the price is far above a moving average, it shows you that you are in a trending market and you're much better off waiting for a pullback into a moving average. Like in this case, we had the impulsive phase, the pullback into the moving average, the continuation, another flag. In this case, we didn't quite reach the moving average, but you can see we pulled very closely back into the moving average. And there are other tools of how we can identify flags if the market doesn't reach a moving average, as we're going to see now. Another really helpful thing is to look at the angle and the speed of price development. When we look here at this bear flag, the bear flag is the exact same, just in reverse. And the bear flag is a downtrend continuation pattern. We have the initial impulse. And when we draw a trend line or when we just look at the angle, we can see that the market has been falling with 47 degrees. So a very strong decline. Then we look at the flag pattern that is building here. And we can see the market is pushing higher with only 11 degrees. So the steepness and the angle is going to tell you a lot. In this market, we have a lot of selling, strong selling with a strong push to the downside, and then weak buying. This distinguishing between strong selling and weak buying, or in the case of a bull trend, strong buying and weak selling, is really important to understand the trending and the market environment and the sentiment behind the price. This shows us that there's a lot of selling interest and not so much buying interest. Now we can add to the same chart. This is still the same scenario. What we did is that I added the moving average, and the moving average helps us again to understand when we are in a trending mode, when the price is far away from the moving average, and when the market is pulling back into the moving average, we have reached a favorable pullback scenario. Those blue lines are the daily pivot points. I made a few videos on my YouTube channel about the pivot points, and they work really well as pullbacks. We saw that here on the left side during the uptrend, the market pulled back into the moving average and also retested the daily pivot point before shooting higher. Then here's the transition. The market goes from an uptrend to a downtrend when the market breaks the pivot, when we make lower lows and lower highs. When we broke the moving average, we retest everything from underneath. Then we move to the downside with the impulsive wave. And now we are retesting the moving average and the daily pivot. So this is, and also by the way here, this huge support and resistance flip zone. And this is a great cluster of confluence. The more price barriers, the more support and resistance tools we can find in an area, the higher the likelihood that the market is not going to break through it. And if you see a breakout on the opposite side through this level, then you will often find great turning points. But at this point, we are in a downtrending market, we have the flag, and here's a lot of resistance that the market is hitting. So what is the trading plan? And there are a few ways of how to approach flags, as we're going to see in this video. But a simple way would be just to look for the last swing low in the flag pattern. So in this bear flag, you can see we have multiple swings. And here is a swing point that if the market breaks it, we're going to make lower lows. So a lower low is always a good indication that the market is turning into a bearish scenario. We can zoom in and wait a few candles, and what we see is that the market broke this previous support level here with these two strong selling candles. Then we retested it, and now the market is rejecting this level from underneath. So we have exited the flag pattern, we have rejected all of the resistance here, we have broken below the last support, the last swing low. It has held as resistance now, and this could then be a great entry point for trend continuation traders. A lot of traders make the mistake of trying to get in the sell position and try to short the market up here. And this is a much more risky approach because you're essentially still going against the short-term momentum because the market has been in the short term going higher. So a much better approach would be to wait for actually the momentum shift. The momentum is shifting when we exit the flag, when we see the strong selling return into the market, and when we see that support is turning into resistance. When we zoom out at the time of the breakout, we can identify a few important levels on the left. Here we have a demand area or an order block, and here we have a fair value gap on the left. So those could be great target levels for a trade to the downside. And what we see is that the market moved into the first demand area, shot higher, retested the moving average, rejected the moving average, and moved into the second fair value gap. And afterwards the market made a double bottom. Now the market is also breaking here above a short-term resistance, and it seems like the market is rolling over. So let's examine another scenario of how we can master and trade the bear flag. So the market is in a downtrend, we have impulsiveness here on the bearish side, and then here the market is pushing higher, and we have this flag. But let's try to examine this chart in more detail, and let's try to find other confluence factors and try to build a trading plan. So the first thing that we see on this chart is that here is a fair value gap. On the breakdown to the downside, the market has left this fair value gap. The flag pattern has pushed into the fair value gap and for now was not able to move very deep into it. So this is a very good resistance level that we can use. But we can look for even more confluence factors. What we do now is we go to a lower time frame. We move from the 1 hour where we found this scenario with the flag to the 15-minute, and here we again see the higher time frame fair value gap. This is the flag, and we are looking for short-term support and resistance. So during the flag, the market kept making higher lows and higher highs, and we want to identify the last swing point. This is the last swing point on the way up, and ideally you want to see the market take out the swing point to make lower lows, which the market was not able to do during the flag, and also we want to get out of the flag to get a momentum shift. This is happening here a few candles later. We suddenly see some strong selling coming back into the market, and the market is taking out previous support, and we are also out of the flag channel. When we are adding the moving average, we can see in the past the moving average held here as resistance. During the flag, the market traded on the bull side of the moving average, and now the market is returning and rejecting the moving average, trading on the low side. So a moving average is a momentum signal or a momentum tool, and depending on which side the market is trading, especially in a trending environment, in a range market the moving average doesn't work as well, but in a trending environment moving averages can be a great tool. The best period setting that I found is the 50 period EMA or SMA. You can also use other settings like the 30 EMA or SMA. And then afterwards, once the market has cleared the low, we see that here is then the next bearish impulsive wave, and we resume the rhythm. Strong selling, weak buying, strong selling. Another example with a different scenario. What do we see here when we break this chart down? We see that the market has been here in this uptrend. During the uptrend, we have this bullish impulsive phase, which came to an end here. We had here a first flag already, and then the market pushed above the resistance. The market took out the resistance and traded into a higher high. From here to here, the market made a higher high, confirming this overall uptrend. And then we see the flag pattern testing previous resistance now as support. It's not a problem that the market is falling here below the support level. A lot of traders worry when their levels or their tools and their zones are not holding precisely and exactly. This is absolutely not necessary. Price action is very dynamic, so it is okay if the market is breaking on the opposite side here of the support and resistance level, as long as the overall context is not changing. Here you can see during this uptrend, here is a swing low. As long as the market is not able to take out this low, which would then indicate lower lows, that would be a problem. But as long as the market is staying above it, the overall bullish sentiment still remains. And then on the breakout out of the flag, the price shoots higher. We take out those highs here, making new higher highs in the overall uptrend. We have another flag pullback. On the continuation breakout, we shoot higher. So a very classic scenario, and if you incorporate support and resistance and overall long-term trending action, that can also help you with your chart understanding. Now let's take a look at a complex chart study. What do we see? The market has been clearly in an uptrend. From the bottom left to the top right, the market has been moving higher. The bullish trending phases here are much stronger than the bearish ones, and that's how the market advances higher. Now we have a pretty deep flag pattern. So let's try to analyze what we see here. First of all, we have here our fair value gap. Below the fair value gap, we have here the demand area that the market has been testing. And as long as this is holding, I would still remain in this overall bullish sentiment. Also, if you would draw a line here on the high point here, you can see that the market is retesting this previous resistance as support once again. So we have indeed a deep pullback, but as long as the overall trending structure is not broken, we remain bullish. We can also add moving average, and here we have the 50, the 30, and the 10 period EMA. And what we see is that during the flag pattern, the market is moving below the moving averages. Also, the red line is the 10 period, the very fast moving average. And as long as the fast 10 period EMA is below the other moving averages, we are more in a bearish scenario. When the red, the fast moving 10 period EMA is above the slower moving averages, you are more in a bullish scenario. Here you can see the moving average. Here the 10 period is first dropping off, signaling the top of the market, and then also falling here below this moving average. And now we have a bearish trend structure given by the moving averages. A few candles later, we see that the market has broken here higher highs. We have exited the flag pattern. We are above the 3 moving averages, and we have a bullish cross here off the moving average. The red 10 period fast moving average is now above the other slower moving averages, giving us a bullish moving average cross, signaling here the continuation. A lot of traders may now say that this is too late and the market has already moved, but if you are trading with a new continuation and if you're looking for a trend continuation, you are hoping and you are betting on a much longer impulsive wave. And in the past, we have seen that the market has very long impulsive trend waves. So that is what we are looking for here. And therefore, it is not important to get in at the absolute low when you're buying. It's not absolutely important to get in the absolute high when you're selling. We all know this famous trading quote: if you go for the third in the middle, the safe part in the trending move, that's where you find your edge. And then you can see the market shoots higher. The moving average here, the red one, stays above the other moving averages, confirming the bullish trend all along. And you can see, even if we didn't get in here on the initial breakout, the market still moved higher afterwards and continued the bullish trend after the flag pattern.